Something is off, and you can feel it before the data confirms it. Jobs vanished in February, 92,000 of them, when forecasters expected gains. Consumer confidence has fallen to a level only seen during actual recessions. Moody's recession model sits at 49%, 1 inch from a line it has never crossed without a crash following. Housing is already in its own quiet collapse. An AI bubble worth hundreds of billions is balanced on 4 companies. Oil is over $112 a barrel. If this video helps you make sense of it, like and subscribe, it genuinely matters. The warning signs are back, and this time something feels different. Let's begin. You felt it before the news did. The grocery cart that costs more than rent did a few years ago. The friend who says they are between jobs and has been between jobs for 9 months. The neighbour who paused the kitchen renovation. The cousin whose hours got cut. The co-worker who quietly took a second job nobody talks about. None of it shows up in a chart. All of it shows up in the way people pause before answering when you ask how they are doing. Economists call this consumer sentiment. Regular people call it the bad feeling. A poll from March of this year found that 40 out of every 100 Americans believe an economic collapse is coming. That is not a fringe number. That is 2 in 5 neighbours, 2 in 5 co-workers, 2 in 5 people standing behind you in line at the pharmacy. Here is the strange part. The headline numbers still look okay. The stock market is near record highs. Unemployment, while rising, is only at 4.4%. Gross domestic product is still growing. If you only read the front page of the financial section, you would think everything is fine. But underneath that headline, something else is happening. The University of Michigan Consumer Sentiment Index fell to 53.3 in March. To put that in plain language, that is a number you only see during an actual recession, not approaching one. During one. The last time consumer sentiment lived that low, the economy was already shrinking. So which is real? The optimistic top-line number, or the gut feeling of 40% of the country? Here is what makes this moment unusual. Both are real at the same time. The economy has split into 2 economies wearing the same name. One belongs to people with assets, with stocks, with paid-off houses, with savings that earn interest. That economy is doing great. The other belongs to everyone else. People who live paycheck to paycheck. People who use a credit card to buy groceries. People who watched the price of eggs double and the price of rent triple while their wage barely moved. If you are standing inside the second economy, the warning signs are not warning signs. They are already happening. The recession for tens of millions of people did not arrive with a bell. It arrived quietly, one shift cut at a time, one cancelled doctor visit, one minimum payment that did not cover the interest. This is why the standard recession question feels broken right now. People keep asking when a recession will start, while the bottom half of the country is asking how much longer they can hold on. A YouGov survey this spring put the number plainly. 40% of Americans expect collapse. 60% feel that prices have outrun their pay. Small business owners are more pessimistic about revenue growth than at any time since the year 2020. None of this matches a healthy expansion. The feeling is not paranoia. It is data wearing different clothes. And when 40% of an economy expects a downturn, they start spending like one is already here. They cancel plans. They delay buying a car. They stop the kitchen renovation. That behaviour, multiplied across millions of households, is how downturns are made. The market may be at record highs, but the mood is not. And the mood usually moves first. February proved it. On the first Friday of March, the Bureau of Labour Statistics released a report that economists had spent weeks preparing to spin. The expected number was a gain of around 50,000 jobs. A soft landing number. A number you could shrug at and call a slowdown. Then, the actual number printed. The American economy had lost 92,000 jobs in February. Unemployment climbed to 4.4%, not a slowdown. A contraction. the Dallas Express. The shock was not just the headline, it was the revisions buried 2 paragraphs down. December had originally been reported as a gain of 48,000 jobs. It was revised to a loss of 17,000. January's gain of 130,000 was revised down by another 4,000. Combined, the previous 2 months were 69,000 jobs lighter than the country had been told. The Hill. Then came the second revision a month later. February's loss of 92,000 was revised even worse, down to a loss of 133,000 jobs. An entire mid-sized city's worth of work vanished in a single month. US Bureau of Labor Statistics. This pattern matters because revisions are how the truth catches up to the headline. The first number is rushed. It is the snapshot taken before all the survey responses arrive. The revision is the picture that develops. And every revision in this cycle has gone in the same direction. Down. Worse. Smaller. A separate annual benchmark found that total non-farm employment for last year was over 1 million jobs lower than originally reported. Every single month from August onward, 1 million phantom jobs. Counted, celebrated, repeated on television, and then erased. If you want to feel how unusual February was, look at where the losses came from. Healthcare, which had been the single biggest engine of job growth for over a year, lost 28,000 positions. Construction lost 11,000. Manufacturing lost 12,000, despite tariff policy designed to bring it back. The information sector, hit by artificial intelligence cuts, lost another 11,000. Federal government employment has fallen by 330,000 since October of 2024, 11% of the entire federal workforce. CNBC. Almost no sector was hiring. The breadth of the weakness was the story underneath the story. Then there was the household survey, the part of the report that calculates the unemployment rate. It showed a drop of 185,000 people reporting at work and a rise of 203,000 in the unemployment level. The labour force participation rate edged lower to 62%, the lowest since December of 2021. CNBC. That participation number deserves a pause. It does not just mean fewer people have jobs. It means fewer people are even looking. They have given up. Economists call them discouraged workers. The label sounds clinical. The reality is a person who has sent out 100 resumes, gotten 3 callbacks, no offers, and stopped applying because every rejection costs another piece of confidence. The average duration of unemployment hit 25.7 weeks, the longest stretch since December of 2021. 6 months, half a year of looking, of savings draining, of credit card balances climbing before someone finds work. That is not a healthy job market. That is a market that has stopped moving. CNBC. One bad month does not make a recession. But February was not one bad month. It was the 3rd negative payroll report in 5 months. And the streak is what makes it different. Here is a number nobody on cable news has wanted to say out loud. The American economy has now posted negative job growth in 5 of the last 9 months. Not slow growth. Negative. Actual losses. That sentence used to be a recession sentence. For most of the last 40 years, 2 consecutive months of negative payrolls was enough to trigger emergency phone calls at the Federal Reserve. 3 was a code red. 5 out of 9, historically, has only happened during or immediately before a recognised recession. So why has nobody called it that yet? Part of the answer is that the losses have been uneven. A negative month here, a positive month there, with revisions cleaning up the mess later. The pattern has been camouflaged by averages. If you take the last 12 months and compute a smoothed line, the picture looks like a slowdown. If you look at the individual months, the picture looks like an economy stalling, lurching, stalling again. Last year was the first calendar year to record 5 months of labour market contractions since 2010, when the economy was still climbing out of the global financial crisis. That is the historical company this streak is keeping, not a normal slowdown. a post-crisis recovery period. NBC News. The other reason for the silence is political. Job numbers have become a fight about narrative. Whoever is in office wants the headlines to read strong. Whoever is out of office wants them to read weak. So the data lands, and within an hour, two completely different stories are competing for attention. But the data does not care. The data shows that since May of last year, when the largest wave of new tariffs was announced, the labour market has lost a net 19,000 jobs. Lost. Not gained slowly. Lost. Over 9 months. In an economy that, by population growth alone, should be adding roughly 100,000 jobs every month just to keep up. CNN. The math is brutal when you do it that way. To stand still, the country needs to add about 1 million jobs a year to absorb new graduates, immigrants, and people re-entering the workforce. Falling short of that million is a slowdown. Going negative is a different category entirely. What makes this streak more concerning is what is hiding inside it. The job losses are concentrating in sectors that used to be safe. Healthcare, the largest employer in the country, is no longer growing. Federal government employment is shrinking on purpose. Manufacturing remains flat despite policy designed to revive it. Information services are shedding workers as artificial intelligence absorbs their tasks. Retail trade keeps quietly losing positions to automation and to consumers spending less. The sectors that are still hiring are smaller, lower paid, and less stable. Social assistance, some pockets of leisure and hospitality, the kind of jobs people take when they cannot find the job they actually trained for. A labour market is supposed to work like a stairway. Workers move up, wages rise as experience grows. Each new generation enters at the bottom and climbs. When a market stalls, the stairway becomes a treadmill. People run faster to stay where they are. When it goes negative, the treadmill starts moving backward. And that is the picture 5 out of 9 paints. The Federal Reserve has noticed. Economists have noticed. The question now is what the next print does. Because if April brings another negative number, this will no longer be a streak. It will be a trend, and trends in labour markets almost never reverse on their own. There is a number that does not come from Wall Street, that does not come from the Federal Reserve, and that has predicted every recession of the last 50 years before thee. Official call was made. It is called the University of Michigan Consumer Sentiment Index. In March, it printed at 53.3. To make sense of that, you need a reference point. As recently as late 2025, the index sat above 70. 70 is not great, but it is functional. People are nervous, but they are still buying. 60 is bad. 55 is alarming. 53 is what economists call recession territory. It is a level historically associated with either an active recession already underway or one about to be officially recognised. Techie. Consumer sentiment matters because consumption drives roughly 70% of American gross domestic product. Read that again. 7 out of every $10 in this economy come from regular people deciding to spend, not from corporate investment, not from government programs, from ordinary households at the grocery store, at the dealership, at the appliance counter, choosing to swipe a card. Techie. When those households feel poorer, they swipe less. When they expect prices to keep rising, they pull forward purchases of durable goods, then cut everything discretionary. The vacation gets cancelled. The new couch waits. The dinner out becomes leftovers. Multiply that decision by 100 million households, and you get a recession built out of 100 million tiny no's. Right now, expected inflation among consumers is sitting at 3.8%. That is the rate that ordinary people, not economists, expect prices to rise over the next year. And here is the thing about expectations. They are not just predictions. They are instructions. People who expect higher prices behave in ways that create higher prices. They demand bigger raises, accept smaller orders, raise their own prices to compete. Inflation expectations have a way of becoming inflation realities. What is unusual about this moment is the gap between sentiment and the headline economy. Stock indexes are near records. Reported gross domestic product is still growing. The official unemployment rate is 4.4%, which historically is a healthy number. By every standard textbook measure, the economy looks fine. But 53.3 says it is not fine. 53.3 says the people inside the economy do not believe what the headlines are telling them. They are looking at their own lives, their own bank accounts, their own grocery receipts, and they are reaching a different conclusion. This is the part where sentiment turns from a survey into a force. When confidence collapses below a certain threshold, behaviour changes. When households feel poorer, they spend less. When they expect inflation to persist, they pull forward purchases of durables and cut discretionary spending, a behavioural pattern that accelerates the very downturn they fear. Techie. It is a feedback loop. Bad mood, less spending, fewer sales, layoffs, worse mood, less spending. Once it starts, it tends to keep going until something breaks the cycle. Usually that something is a Federal Reserve emergency rate cut, or a fiscal stimulus, or a sudden return of confidence triggered by an unexpected piece of good news. None of those have arrived. The Federal Reserve, in fact, is holding rates steady. There is no major stimulus on the table, and the headlines have been, if anything, getting worse, not better. So the question becomes which way the sentiment number moves next. If it stays at 53, it confirms a downturn. If it falls further, it accelerates one. The next reading is going to matter more than the next earnings season. Most recession predictions are guesses dressed up in suits. Forecasters give probabilities. The probabilities update. Nobody is ever fully wrong, because nobody ever fully commits. There is one model that does commit, and it has earned the right to. The Moody's Analytics machine learning recession model is built on decades of historical data. It does not care about narratives or political cycles. It looks at the actual signals the economy gives off before a downturn, weights them, and outputs a single probability. Once that probability crosses 50%, a recession has followed within 6 to 12 months, every single time, since 1945. Techie. That is the track record. 80 years. Every recession in the modern American economy. Not one false signal once it crossed the line. Right now, the model sits at 49%. Techie. 1% below the line. One bad data print, one geopolitical escalation, one credit market wobble, and it crosses. The last time the model sat this high without an actual recession following was September of 2007. Techie. If that date sounds familiar, it should. The financial crisis began the next year. What makes this number especially heavy is the company it keeps. Other major forecasters have moved in the same direction, just less aggressively. Goldman Sachs raised its recession estimate from 25% to 30%, citing oil supply shocks and tariff escalation with China. SP's jump was the steepest in the group, and SP's jump came from credit market pricing rather than a subjective economist call. When bond traders move that aggressively, they are usually moving on information the public does not have yet. Techie. The New York Federal Reserve runs its own model. It uses the spread between long-term and short-term Treasury yields, a classic recession signal. As of February, the New York Fed model showed an 18.7% chance of a recession by January of 2027, lower than Moody's, but rising. US News & World Report. Why the gap? The New York Fed model is conservative by design. It focuses on yield curves, which have already uninverted. The Moody's model is broader. It pulls in employment trends, consumer credit, manufacturing surveys, oil shocks, and dozens of other inputs. The broader model is seeing more signs of weakness than the narrow one. That divergence itself is informative. It tells you the warning is not coming from any single sector, it is coming from the combination. Employment is weak. Consumer sentiment is at recession lows. Oil is up. Tariffs are biting. Banks are tightening loans. Each one alone might be survivable. The aggregation is what worries the model. What does 49% feel like in practice? It means the chance of a recession, weighted across all visible signals, is essentially a coin flip. That is not normal. In a healthy economy, the model sits in the single digits. In a slowing economy, it might reach the teens. 49 is a number that historically only shows up when the next 12 months are about to be ugly. There is, of course, the other side. Even at 49%, the Moody's model assigns a 51% probability to no recession. The bull case rests on a few real catalysts. Artificial intelligence capital spending is still surging. The Federal Reserve has room to cut rates if things deteriorate. Consumer balance sheets in aggregate look better than they did before previous downturns. A soft landing remains technically possible. Techy, but possible is not the same as likely. And 49% in this model has historically been the moment before the moment, the 8 months in 2007 before the 8 months that broke the world. The signal, in other words, that something is closer than the headlines suggest. The question now is whether the next print pushes it past 50. There is no longer one American economy. There are two, running on the same currency, the same calendar, and the same news cycle, but living in different decades. Economists call it K-shaped. Imagine the letter K. One line goes up and to the right, the other goes down and to the right. Same starting point. Different futures. That is the country right now. The top line belongs to people who own assets. Houses bought before 2020. Stocks held through the last decade. Retirement accounts that compounded through the longest bull market in history. Hyperscalers like Microsoft, Google, Amazon and Meta have collectively committed over $250 billion in artificial intelligence spending for this year alone. That money flows through to shareholders. Shareholders are mostly the top line. Techie. For these households, the last few years have been a story of multiplication. Their houses appreciated. Their portfolios grew. Their cash earned 5% in a money market fund for the first time in a generation. They feel wealthier because they are wealthier. The bottom line belongs to everyone else. People who rent. People who do not own stock. People who watched grocery prices climb 30% while their wages climbed 8%. People who cannot afford to buy a starter home at current rates because the monthly payment on a median home now eats half their income. For these households, the last few years have been a story of subtraction. The same paycheck that bought a full cart of groceries in 2020 buys 2/3 of one now. The same rent has gone up 2 or 3 or 4 times. The same car insurance has doubled. The math has gotten harder, not easier, even as the headlines say things are improving. A New York Federal Reserve researcher said it plainly in a February press call. There is evidence consistent with a K-shaped economy. Some groups are really struggling. The bureaucratic language is doing a lot of hiding. What that sentence actually means is that the country has split, and the regulators know it. Drop the. You can see the split in the credit data. Overall credit card delinquency fell to 2.94% in the fourth quarter of last year, the 5th consecutive quarterly decline. A casual reader sees that and thinks consumers are fine. But the average hides the bifurcation. Delinquency is improving in affluent areas and worsening in low-income zip codes. The top is paying off cards. The bottom is falling behind. Drop the. The same pattern shows up in retail. Luxury sales are still strong. Discount retailers are reporting record traffic. The middle is hollowing out. Stores that catered to the broad middle class, the kind of stores your parents shopped at, are closing locations or going bankrupt outright. The middle ground has nobody standing on it. The political consequences are obvious and getting louder. The top line keeps reading headlines about strong markets and wonders why the country feels angry. The bottom line keeps living through a recession the official statistics refuse to acknowledge. Both sides are looking at the same numbers and reaching opposite conclusions, because the numbers, when averaged, hide the fact that one half is climbing while the other half is falling. This is the trap underneath this entire conversation. When forecasters ask whether a recession is coming, they are asking whether the average will go negative. When ordinary people ask the same question, many of them are asking how long the bottom of the K can keep falling before something breaks. For the bottom 60% of households, the recession may not be coming. It may already be here. The problem is that recessions are called by averages, and averages are written by the top. Picture a woman in Des Moines standing at a checkout counter. Her cart has eggs, milk, bread, 2 boxes of cereal, a package of ground beef, some apples. The total comes to $47. She pulls out a credit card. She is going to carry the balance. If she carries that $47 for a year at the average credit card interest rate, she will pay $10.48 in interest. On groceries. On food that will be eaten before the bill arrives. Drop thee. This is the American credit card economy in 2026. The Federal Reserve Bank of New York reports total credit card debt hit $1.28 trillion in the fourth quarter of last year. That number is so large it stops registering. Translate it. 175 million people. 648 million credit cards. An average interest rate of 22.3%. More than half of those cardholders carrying balances on essentials they cannot pay cash for. Drop thee. To compare, the average 30-year mortgage rate sits around 6.8%. An auto loan runs about 7.5%. A personal loan, maybe 12%. Credit cards charge 3 times what a mortgage costs. And unlike a mortgage, the asset on the other end might be a bag of groceries that was eaten 2 months ago. The Federal Reserve started cutting interest rates late last year. The credit card industry did not pass those cuts through. New card offers from JP Morgan Chase, Capital One, and American Express averaged 23.77% in February of this year. The spread between what banks borrow at and what they charge consumers is the widest it has been in decades. That spread is intentional. It is how banks earn through a downturn. Here is the part that should worry anyone trying to read the economy. About 60% of credit card users carry a balance month to month. 60%. 3 out of every 5 Americans with a card are paying interest on something. Sometimes that something is a vacation. Sometimes it is a medical bill. Increasingly, it is groceries. Drop thee. This is where the bifurcation gets brutal. People with money pay off their cards every month. They earn rewards points, cashback, airline miles. The credit card is a tool for them, not a debt. People without money carry balances. They pay 22% on the privilege of buying food in advance of their next paycheck. The card is not a tool for them, it is a slow leak. The loop tightens over time. A balance that grows by 22% a year doubles in a little over 3 years if you make minimum payments. The minimum payment is designed to cover interest plus a tiny bit of principal. It is structured to keep you in debt. And once you are in deeply enough, you are functionally renting your own past spending, paying interest on milk you drank in 2023. Delinquency rates on consumer loans rose to 4.8% of all outstanding household debt in the fourth quarter, the highest level since 2017. The rise is being driven by lower income and younger borrowers, the same people most likely to be using cards for groceries. Bloomberg. What makes this dangerous on a national level is what it implies about consumer spending. If a meaningful share of consumer spending is being financed by credit cards at 22%, then that spending is borrowed from the future. Every dollar charged today is less than a dollar of real demand. It is a dollar plus interest that will need to be paid back, eventually, out of income that has not arrived yet. When the credit card spigot tightens, and banks have already started tightening it for risky borrowers, that future spending evaporates, not slowly, all at once. The Des Moines grocery cart is small. Multiply it by 75 million carts. If you ask most Americans whether the housing market is in recession, they will say no. The headlines have not used that word. The official economic indicators do not yet say it. But ask any builder, any real estate agent, any mortgage broker working the front lines, and you will get a different answer. Kurt Long, chief economist at America's credit unions, said it plainly in January. One of the few places in the economy we can speak about definitively is housing, and the picture there is not good. He pointed to long-term sales declines and sluggish construction activity. His conclusion was simple. The housing sector has already slipped into its own recession. Newsweek. It is just one that the rest of the economy has not caught up to yet. Housing in this country is not just one sector. It is the foundation of household wealth. About 65% of Americans own their primary home. For most of those owners, the house is the single largest asset they will ever hold. When housing slows, household wealth feels it before any other indicator. The slowdown started quietly. Mortgage rates climbed past 7% and stayed there. The 30-year fixed, which sat near 3% during the pandemic, more than doubled. Suddenly, a family that could have afforded a $400,000 house at 3% could only afford a $260,000 house at 7%. The same income. A smaller house. Or no house at all. The result was predictable. Buyers paused. Sellers, many of them locked into ultra-low pandemic-era mortgages, refused to sell. Why give up a 3% loan to take on a 7% one? The market froze. Existing home sales fell to their lowest levels in 3 decades. Inventory piled up in some metros and vanished in others. Builders responded the way builders always respond to weak demand. They stopped building. New home starts have been declining for over a year. Building permits, which lead actual construction by several months, fell sharply in March, contributing to the steep decline in the leading economic index. Permits are the single most forward-looking housing indicator. When permits fall, construction will fall 4 to 6 months later. When construction falls, construction jobs fall right after. Conference board. The damage is already showing up in employment. February's jobs report logged 11,000 construction jobs lost. Not from a hurricane or a strike, from a market that is no longer commissioning new buildings. Multiply that across 10 months, and you start to see why the leading indicators look so bad. There is another piece of the housing story that does not show up in the median price headlines. Property values in some cities are falling. Florida and Texas, which led the pandemic boom, are now leading the correction. Insurance costs there have exploded due to climate risks, making ownership more expensive even when prices fall. Property tax assessments, which lag market values, are still climbing. Owners are getting squeezed on both sides. For first-time buyers, the math has never been worse. Affordability has reached historic lows. The combination of high prices, high rates, and stagnant wages means that the typical American household can afford about half the house their parents could at the same age. Home ownership, the centerpiece of the post-war middle class, is becoming a generational impossibility for the bottom half of millennials and most of Generation Z. Techie. This matters for the broader economy because housing creates jobs. Real estate agents, mortgage brokers, appraisers, inspectors, contractors, electricians, plumbers, landscapers, movers, furniture sellers, appliance manufacturers, all of them depend on transactions. When transactions stop, the ripple is enormous. The housing recession is not coming. It arrived. The rest of the economy just has not caught up yet. Inside the economic indicator world, there is one number that gets watched more closely than almost any other, and most people have never heard of it. Building permits. A building permit is exactly what it sounds like. A piece of paper a developer or homeowner has to file before construction can begin. The document costs almost nothing. It commits the filer to almost nothing. But the act of filing is a vote. Someone, somewhere, looked at the future and decided to put real money into the ground. When permits rise, builders are betting on demand. When permits fall, builders are betting against it. And builders, historically, are right more often than economists. In March, building permits declined as a major component of the falling leading economic index, alongside weakening consumer expectations and stock prices. The decline was not a small dip, it was a sharp reversal. Permits had been wobbling for months. In March, they fell hard. Conference board. What makes this signal so reliable is how early it fires. Permits lead actual construction by about 4 to 6 months. A permit filed in March will not turn into a hole in the ground until summer or fall. Construction jobs created by that hole will not show up until late this year. So when permits fall in spring, the real economic pain often arrives in autumn or winter. The permit data is also widespread in a way that other indicators are not. There is no single national real estate market. There are thousands of local markets, each filing their own permits, each making their own bets. When permits fall in just a few cities, it is a regional story. When they fall across most major metros simultaneously, it is a national one. The current decline is national. Construction employment in this country is roughly 8 million people. Those 8 million are concentrated in a handful of trades: framers, electricians, plumbers, drywall installers, roofers, concrete workers, heating and cooling technicians. Each trade depends on a steady pipeline of new projects. When the pipeline thins, some workers shift to renovation jobs. Renovation work is smaller, less profitable, and saturates quickly. After that, layoffs follow. The cycle is familiar to anyone who lived through 2007 and 2008. Permits fell first. Then construction stopped. Then construction workers were laid off. Then those workers stopped buying things. Then retailers laid off workers. Then those workers stopped paying mortgages. The dominoes were not random. They followed a predictable order. Right now, the country is at the first domino. Permits down. Construction softening. The next dominoes are coming. There is a related indicator worth mentioning. The National Association of Home Builders runs a monthly sentiment survey of builders themselves. The survey asks builders how they feel about current sales, expected sales, and traffic of prospective buyers. The index has been declining for months. Builders are reporting fewer walkthroughs, fewer offers, and more incentives required to close deals. Some builders are now buying down mortgage rates for buyers, taking the loss themselves to move inventory. That is a sign of distress, not strength. There is also the multifamily side, which often gets ignored. Apartment construction, which boomed during the pandemic, has now collapsed. Permits for multifamily buildings are at their lowest in over a decade. A wave of new units is finishing construction this year. After that wave, the pipeline goes dry. Rents in some markets will probably ease as those units come online. Then construction will stop being a tailwind and start being a drag. Pull all of that together, and the picture is clear. Construction, which represents one of the most cyclical and labour-intensive parts of the economy, is contracting. The leading indicator of construction is permits. Permits are falling. The lag is short. The math is brutal. Something is going to give in the next 2 quarters, and it is most likely to give in jobs. The next chapter follows the money to where the cracks are widest. Averages lie. They lie politely, with charts, but they lie. The American economy has spent the last year being described by averages. Average wage growth, average unemployment, average credit performance. Read those averages and the country looks like it is muddling through. Read the underlying distribution and the country is splitting apart. The Federal Reserve Bank of New York's quarterly household debt report showed delinquency rates rose to 4.8% of all outstanding household debt in the fourth quarter, the highest level since 2017. But that headline number does not tell you who is delinquent. The delinquency is concentrated heavily. The rise is driven by higher defaults among low-income and young borrowers. Bloomberg. In other words, the people with the least cushion are the ones running out of cushion first. The geography is just as stark. Researchers at the New York Fed pulled the data by zip code. In wealthy zip codes, credit card delinquencies are still falling. People in those areas paid down balances during the pandemic, hold significant savings, and have not been forced to choose between groceries and the credit card bill. In low-income zip codes, the picture has flipped. Delinquencies there are climbing back toward levels last seen in the years before the Great Recession. This bifurcation is not random. It maps almost perfectly onto the bifurcation in everything else. The wealthy zip codes are also the ones with stable employment, more remote work options, higher home equity, and larger investment portfolios. The lower income zip codes are concentrated in service industries, frontline jobs, manufacturing towns, and rural communities. When the economy slows, those are the jobs that go first. The mathematics of credit card debt under stress is unforgiving. A balance growing at 22% annually does not stand still. If a household stops being able to pay the full statement and only makes minimums, the balance compounds quickly. A $2,000 balance can become $3,000 within 18 months. A $5,000 balance can become $7,000. The hole digs itself deeper while the household is struggling just to keep the roof on. What happens after delinquency is its own quiet crisis. After 90 days late, accounts get charged off, meaning the bank writes them off as a loss and sells them to a collection agency for cents on the dollar. In the fourth quarter, the share of consumers with third-party collection entries on their credit reports sat at 4.6%. Those entries follow people for 7 years. They make it harder to rent, harder to get a job, harder to qualify for a car loan, harder to get back on stable footing. Wolf Street. The cycle, once it starts, is brutally hard to escape. A household that falls behind on cards loses access to those cards. They turn to higher interest options. Payday loans. Buy now, pay later services. Title loans. Each of those products charges effective rates well above 30%, sometimes well above 100% annualized. They are designed for people in distress. They make distress worse. There is one signal embedded in the delinquency data that deserves separate attention. Auto loan delinquencies. Cars are different from credit cards. People will pay almost any price to keep their car, because losing the car often means losing the job. When auto loan delinquencies rise, it means people are running out of options not just for credit, but for survival. TransUnion forecasts auto loan accounts 60 days past due to reach 1.54% by the end of this year, marking the 5th straight year of higher delinquencies. 5 years of rising. Each year a little worse than the last. The increases have been getting smaller, but the direction has not changed. That is a slow grind, not a sudden break, and slow grinds are how the bottom of a K gets ground down. TransUnion. Hidden inside national averages is a country splitting. The next chapter takes the splitting one floor down into the small businesses watching it happen on Main Street. A car is not a luxury in most of America. It is the prerequisite for having a job. No car, no commute. No commute, no paycheck. No paycheck, no anything. Which is why the auto loan market is one of the most sensitive indicators of household stress in the entire economy. People will skip credit card payments before they skip car payments. They will skip rent before they skip car payments. The car comes first, because the car is how they earn the money to pay for everything else. So when auto loan delinquencies start rising, it means something has broken at a deeper level than the credit card data shows. People are not just behind on discretionary debt, they are behind on the debt that lets them keep working. The trend has been quietly building for half a decade. Accounts 60 days past due are expected to reach 1.54% this year, the fifth consecutive year of rising delinquencies. Each yearly increase has been progressively smaller, suggesting the worst pressure has been priced in. But the cumulative picture is clear. More households than at any point in over a decade are falling behind on the loan that keeps their job possible. TransUnion. The reasons are layered. The average new car price now sits above $48,000. The average monthly payment on a new car loan crossed $750. Interest rates on auto loans have climbed alongside everything else, with new loans averaging 7.5% for prime borrowers and well above 10% for subprime. A worker who could comfortably afford a new vehicle 5 years ago now cannot. The used car market, which used to be the safety valve, has its own problem. Used car prices spiked during the pandemic and never fully normalised. A 3-year-old car often costs 90% of what the same model new would have cost in 2019. Buyers going used to save money are saving less than they expect. Lenders extended terms to make the math work. 6-year auto loans became standard, 7-year loans appeared, 8-year loans now exist. Stretching the term keeps the monthly payment manageable, but it puts borrowers underwater for years. They owe more than the car is worth for most of the loan's life. If they hit a financial bump and need to sell, they cannot. The car is not an asset, it is a chain. This is where the subprime auto market becomes a flashing light. Subprime borrowers, those with credit scores below 640, are now experiencing delinquency rates above 6%. Some niche lenders are reporting numbers above 10%. These are levels normally seen during a full recession. They are happening now, in an officially expanding economy. Repossessions have been rising as a result. Tow trucks are working overtime. Used car lots are getting crowded with reclaimed inventory. The flow of repossessed vehicles back into the market has started to put pressure on used car prices, which are now finally beginning to soften. That softening is good for buyers, bad for the millions of borrowers whose loans are valued against falling collateral. The connection between auto stress and the broader economy is not subtle. Auto manufacturing employs hundreds of thousands of Americans directly and millions indirectly. Dealerships, parts suppliers, insurers, mechanics, transport companies, and lenders all depend on a healthy auto market. When sales slow, the ripple is enormous. There is also a feedback loop with employment. A worker who loses their car often loses the job that the car made possible. Without a job, they fall behind on other debts. Other debts dragging on credit scores make it harder to get another car. The ladder out of the hole gets shorter every step. Auto delinquencies are not a market story. They are a household survival story. And when households start failing the most essential test of household economics, the broader economy is rarely far behind. Wall Street and Main Street do not always tell the same story. When they disagree, Main Street usually turns out to be right first. Right now, they are disagreeing loudly. The Small Business Credit Survey released by the Federal Reserve found that the share of small businesses anticipating revenue growth dropped to its lowest level since 2020. 2020, the year a global pandemic shut down the world economy. That is the comparison point for current small business expectations. Pandemic levels of pessimism in an officially expanding economy with no plague and no shutdown. Newsweek. Expectations for employment growth among small businesses also sank to multi-year lows. Small business owners are not planning to hire. In many cases, they are planning to cut. Small businesses matter for reasons beyond their numbers. They employ roughly half the country's private sector workforce. They are the first line of expansion in good times and the first line of contraction in bad ones. They are also closer to the ground than any economist or executive. A restaurant owner sees foot traffic fall before the official retail sales report comes out. A landscaping company sees clients cancel before the real estate market shows weakness. A small manufacturer sees order books thin before the manufacturing index ticks down. When that group says it expects worse, it is rarely wrong. The reasons they cite are familiar. Customer traffic is down. Costs are up. Insurance is more expensive. Rent for commercial space has climbed. Labour, while easier to find than 2 years ago, is still expensive relative to revenue. The combination is squeezing margins to nothing in industries that had thin margins to begin with. There is also a new concern that did not exist a few years ago. Tariffs and supply chain disruptions are hitting small businesses harder than large ones. A multinational corporation has multiple suppliers in multiple countries. It can route around a tariff. A small importer with one supplier in one country has nowhere to route. They eat the increase, pass it on, or close. Many are choosing to close. Bankruptcy filings among small businesses have been climbing for over a year. Most do not make headlines because most are too small to attract attention individually. They show up only in aggregate in the slow rise of vacant storefronts and empty office parks. Drive through the outer rings of any mid-size American city and you can see the data without needing a chart. There is also a credit problem. Small businesses borrow primarily from regional banks, and regional banks have been tightening lending standards for 2 years. Recent surveys indicated stricter standards for commercial and industrial loans for businesses of all sizes, as well as weaker demand for several forms of household credit. Even when small businesses want to borrow to expand or to bridge a slow period, banks are saying no more often than yes. Newsweek: the credit tightening creates its own feedback loop. Without credit, expansion stops. Without expansion, hiring stops. Without hiring, consumer spending in the local area weakens. Without local spending, other small businesses see their revenue fall. The cycle accelerates from one block to the next. Small business confidence has historically been one of the most reliable forward indicators of the broader economy. The current readings are not just below average. They are at levels that in past cycles have been followed by recessions within 12 months. The Wall Street version of the economy says corporate profits are healthy and the stock market is fine. The Main Street version says revenue is weak, hiring is stalled, and credit is hard to get. One of those stories is closer to ground truth. The street with the most local restaurants and the most independent shops usually wins. There is one signal that has been screaming for so long that it has stopped being news. That is part of the problem. Familiarity breeds dismissal. The Conference Board leading economic index, known as the LEI, is built from 10 forward-looking indicators. Stock prices, consumer expectations, building permits, manufacturing orders, the yield curve, average weekly hours worked, initial unemployment claims, business credit conditions. The index is designed to do one job: tell you what is coming. The leading economic index for the United States declined by 0.6% in March, more than reversing its 0.3% increase in February. Over the 6 months between September of last year and March of this year, the index fell by 1%. That is on top of a 2.1% decline in the previous 6 months. Conference Board. Translate that into plain terms. The LEI has been falling, with brief interruptions, for 19 straight months. That streak is one of the longest in the history of the index. Historically, runs that long have always coincided with a recession. Until this cycle. Which raises the obvious question: why has there been no recession yet? The answer is messy and partial. The index was built decades ago, when the American economy was more concentrated in manufacturing, more sensitive to interest rate cycles, and less driven by services and technology. The components, while still informative, may overweight parts of the economy that matter less than they used to. Stock prices, for example, are now driven heavily by a handful of mega-cap technology firms whose earnings are decoupled from the broader business cycle. The yield curve, another component, has uninverted over the past year, complicating its traditional signal. Some economists have argued that the LEI is now broken. They say the structure of the economy has changed enough that the historical track record no longer applies. A 19-month decline used to mean recession. In this cycle, it might just mean slowdown. Maybe. But here is the counter-argument, and it is uncomfortable. The lay has been wrong before only in cycles where the Federal Reserve cut rates aggressively to engineer a soft landing, or where massive fiscal stimulus interrupted the trajectory. Both of those interventions have happened in past cycles. Neither is happening now. The Federal Reserve has cut rates only modestly. The federal funds rate sits between 3.5 and 3.75%. There has been no emergency cut. There has been no quantitative easing. The Fed has been holding rates steady through the most recent decline, citing sticky inflation as a reason not to act faster. There is also no significant fiscal stimulus on the table. There has been talk of $2,000 tariff rebate checks heading into the midterm elections, which could push spending up, but the math has not been finalised. No major infrastructure package is moving through Congress. No emergency unemployment extensions exist because unemployment has not yet officially spiked. The fiscal cushion that softened previous cycles is largely absent. Think. Without intervention, the lay's historical pattern is most likely to play out the way it always has. Recession follows. The only question is timing. There is one more wrinkle worth noting. The Conference Board's Coincident Economic Index, which measures the current state of the economy, was unchanged in March and February at 115.2. Coincident is the present tense. Leading is the future tense. The present tense is flat. The future tense is falling. The gap between them is the warning. Conference Board. Eventually, the present catches up to the future. Whether it happens this quarter, next quarter, or in 2 quarters, the lay is saying it is coming. 19 months of falling indicators do not lie about direction. They only lie, sometimes, about speed. For about 2 years, every economist worth their fee was watching one chart. The yield curve, specifically the gap between the 10-year Treasury yield and the 3-month Treasury yield, or the 10-year minus the 2-year. Different versions, same idea. The yield curve had inverted. Short-term rates were higher than long-term rates, which is the opposite of what is supposed to happen. An inversion has preceded every American recession in the modern era, with one exception. So when the curve inverted in 2022, the recession countdown clock started ticking. It ticked for a long time. Now the curve has uninverted. As of early May, the 10-year Treasury sits at 4.39%, and the 2-year sits at 3.88%. Long-term is once again higher than short-term, the way it should be in a normal economy. Polymarket. To a casual observer, this looks like good news. The recession signal has flipped off. The danger has passed. It has not. Here is what almost nobody mentions about yield curve inversions. The recession does not happen during the inversion. It happens after the curve uninverts. The uninversion is the signal that the bond market is starting to price in the slowdown the inversion was warning about. Look at the historical pattern. The curve inverted in 2006. It uninverted in early 2007. The financial crisis hit later that year and accelerated through 2008. The curve inverted in late 1999. It uninverted in 2000. The dot-com recession started right after. The curve inverted in 1978. It uninverted in 1979. The double-dip recession of 1980 and 1981 followed. The pattern repeats. Inversion warns. Uninversion fires. The reason is mechanical. The curve inverts when the Federal Reserve has rates higher than the bond market thinks is sustainable. When the Fed starts cutting, short-term rates fall faster than long-term rates, and the curve normalizes. The Fed cuts because the economy is weakening. By the time the curve has fully normalized, the economy is usually already in trouble. The current uninversion fits the pattern. The Fed cut rates 3 times in late 2025 before pausing. The pauses came because core inflation remained sticky around 3%. The cuts shifted the short end. Long-term yields stayed elevated because of rising deficit concerns and ongoing inflation worries. The result was a normalization that looks healthy and is actually the early stages of a downturn signal. There is one more wrinkle in the yield curve story. Long-term yields have stayed unusually high relative to where most economists expected them to be. The 10-year at 4.39% is well above the average of the last 15 years. That elevated long end means borrowing costs for households and businesses, especially mortgage rates and corporate bond rates, are not falling as fast as the Fed cuts would normally produce. This matters because monetary policy works through borrowing costs. If the Fed cuts but long rates do not fall, the economy gets less stimulus from each cut than the historical playbook would predict. That is part of why the labour market is weakening, even as the Fed is technically in an easing cycle. The cuts are landing softer than expected. The yield curve is no longer a recession warning, it has become a recession countdown. The clock now reads months, not years, which is exactly what makes the next chapter's signal so important. The SARM rule. There is one economic indicator that does not predict recessions. It identifies them in real time with an accuracy that nothing else has matched. It is called the SARM rule. The rule was developed by Claudia Sahm, a former economist at the Federal Reserve. The idea is simple enough to sketch on a napkin. When the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more above its lowest reading from the previous 12 months, a recession has begun. Fred. Half a percentage point. That is the threshold. It sounds tiny. It is anything but. The reason it works is mechanical, not statistical. Unemployment does not drift upward gradually. It either holds steady or it spikes. When it starts spiking, the spike feeds on itself. Layoffs cascade. Spending falls. More layoffs follow. Once unemployment has risen by half a point above its recent low, the cascade is already underway. The SARM rule simply identifies the cascade as it happens. The track record is striking. Every American recession since the 1970s has triggered the SARM rule before the National Bureau of Economic Research, the body that officially dates recessions, formally declared one. The rule's signal has often arrived months before the official call, in some cases more than a year before. So where does the rule sit now? The unemployment rate climbed to 4.4% in February. The previous 12-month low was around 4%. The 3-month moving average is creeping upward as the more recent prints have come in higher than the prints from late last year. The SARM rule has not formally triggered, yet. It is close. Closer than most casual readers realise. The exact triggering will depend on the next few unemployment prints. The next release is scheduled for May. If unemployment holds at 4.4 or rises further, the 3-month average will continue climbing. The threshold gets closer with each tick. Fred. Sahm herself has been cautious about declaring her own rule triggered. She has argued that the post-pandemic economy may be different in ways the rule was not designed to handle. Labour force participation, immigration patterns, and remote work have all complicated the historical signal. Half a point of unemployment rise in 2026 may not mean exactly what half a point meant in 1975. But cautious is not the same as dismissive. Even Sahm has acknowledged that the underlying trends in the data are concerning. The labour market is weakening. The pace of weakening is accelerating. The historical pattern, even if blurred, is still visible. The Federal Reserve takes the SARM rule seriously. They have to. Every decision they make about interest rates is conditioned on labour market data, and the SARM rule is the cleanest available real-time indicator of labour market health. When the rule moves toward triggering, internal Fed deliberations shift. The case for cutting strengthens. The case for waiting weakens. There is something almost poetic about how the rule works. It does not predict the future. It simply notices, faster than any other tool, when the future has arrived. Most recession indicators look at trends and try to forecast where they will go. The SARM rule looks at unemployment and asks one question: has the cascade started? The cascade is not yet confirmed, but it is closer than it has been at any point in this cycle. And what comes next, in the broader economy, depends on whether the cascade actually fires. If unemployment in April or May prints at 4.5 or higher, the rule triggers. Recession on its terms begins. The historical pattern says everything else follows from there. Spending falls. Corporate earnings miss. Layoffs spread from cyclical industries to defensive ones. Household debt stress accelerates. The next few unemployment reports are not just data points, they are decision points for the entire trajectory of this cycle. The single biggest reason the American economy has not yet broken is also the single biggest risk to it. Artificial intelligence. For the last 2 years, an enormous tide of corporate spending has flowed into one place. Data centers. Semiconductor purchases. Power infrastructure for the data centers. Engineers and researchers to build the models that run on the data centers. The scale is hard to grasp. The hyperscalers, Microsoft, Google, Amazon and Meta, have collectively committed over $250 billion in artificial intelligence-related capital expenditure. For this year alone, some estimates put the total higher, well over $300 billion, when smaller cloud providers and enterprise software firms are included. Techie. To understand the magnitude, compare it to other historical capex booms. The total spending on the railroad expansion of the 1880s, adjusted for inflation, was smaller. The total spending on the original telephone network build-out was smaller. The fibre optic boom that preceded the dot-com crash was, depending on who is counting, of similar scale, but it was spread over a decade. The current artificial intelligence build-out is happening in roughly 2.5 years. This spending is real economic activity. It builds buildings, it hires workers, it buys chips that get manufactured in factories that hire more workers, it commissions power plants, it generates orders for cooling systems, networking equipment, server racks, security software. The ripple is enormous and quantifiable. Without this capex, the broader economy would already be in worse shape than it is. That is the good news. The bad news is what happens if the bet does not pay off. The current spending assumes that artificial intelligence will, within the next few years, generate enough revenue and productivity to justify the cost. The hyperscalers are not building this infrastructure for fun. They are building it because they believe enterprises will pay enormous sums to use it, and that the productivity gains across the economy will compound for decades. Maybe they are right. There is genuine evidence that AI is transforming workflows in some industries: customer service, software development, marketing copy, drug discovery, legal research. The productivity gains in these fields are real. They are measurable. They are also still small relative to the cost of the build-out. The question is whether the gains scale fast enough to cover the bills. The bull case sees AI capex functioning as a private sector fiscal stimulus that partially offsets the drag from higher oil prices and tighter monetary policy. The bear case sees the build-out as a classic asset bubble, massive spending on infrastructure that gets built faster than the actual demand to use it. Techie. Both versions can coexist for a while. A bubble that is also producing real productivity is harder to identify than one that is only inflating prices. The dot-com era was similar. Some of the infrastructure built then was wasted. Most of it eventually became the backbone of the modern internet. The companies that built it mostly went bankrupt before they could collect the returns. The signs of bubble behavior are all visible. Valuations of artificial intelligence startups in the private market are detached from current revenue. Public companies tied to AI infrastructure trade at price-to-earnings multiples that assume aggressive growth for many years. Power companies are commissioning new natural gas plants and even reactivating retired nuclear sites to feed the data centers. on contracts that depend on the data centers, actually using the power they have ordered. If demand falls short, the cascade is not subtle. The hyperscalers cut their orders. The chipmakers' earnings collapse. The data center construction slows. The construction workers get laid off. The power plants get stuck with stranded assets. The enterprise software companies that were betting on AI revenue restate their projections downward. $300 billion is enough to create a lot of jobs. It is also enough, if it deflates, to break a lot of them. The next chapter follows the money one layer deeper into the banks holding the loans that finance all of it. The artificial intelligence boom is not just funded by corporate cash. It is funded, increasingly, by debt. And the debt is sitting on the balance sheets of American banks. Across large banks, commercial and industrial outstanding exposure to AI-adjacent industries averages 9% of Tier 1 capital. However, average bank-committed exposure to AI-adjacent industries is closer to 25% of Tier 1 capital. Federal Reserve Bank of Chicago. Tier 1 capital is the most important number on a bank's balance sheet. It is the cushion, the money the bank has set aside to absorb losses. When Tier 1 capital runs out, the bank fails. When committed exposure to a single risk factor reaches 25% of Tier 1, that single risk factor has become a systemic concern. The Federal Reserve Bank of Chicago published a paper this winter laying out the math. The total committed exposure to AI-adjacent industries across large banks has grown from about $250 billion in 2015 to roughly $450 billion by late 2025. That is software companies, energy companies building infrastructure for AI, and semiconductor manufacturers. The exposure is concentrated in industries that did not even exist in their current form a decade ago. The risk is not that the loans will all default. The risk is what happens if a meaningful share of them do. Here is the scenario the Chicago Fed sketched. A demand shock hits artificial intelligence revenue. Growth slows. Some firms miss earnings. Their credit ratings get downgraded. They draw down their lines of credit before becoming delinquent, because lines of credit are usually still available to firms that have not yet missed payments. The drawdowns turn the bank's committed exposures into actual outstanding exposures. Tier 1 capital ratios deteriorate. Banks tighten lending across all sectors to preserve capital. The credit crunch spreads from AI to everything else. This is exactly how 2007 turned into 2008. The initial shock came from subprime mortgages. The contagion came from the way subprime defaults forced banks to tighten lending across all asset classes, freezing credit for healthy borrowers who had nothing to do with. Subprime. The artificial intelligence credit picture is not subprime. The borrowers are mostly investment grade. The collateral is real in the form of physical infrastructure. The risk profile is different. But the structural similarity is uncomfortable. A concentrated exposure to a single thematic bet built up over a few years of euphoria, with credit lines extended on assumptions that have not been stress tested. There is also a related market that deserves attention. Private credit. Private credit funds collectively manage roughly $2 trillion in lending. Leveraged loans, the riskier corner of corporate credit, total another $1.5 trillion. A significant share of both flows to private equity-backed software and data services firms, many of which carry high debt loads relative to revenue. CNBC. UBS analyst Matt Mish has modelled what an aggressive AI disruption would do to these markets. In his base case, defaults in leveraged loans rise by up to 2.5%, and defaults in private credit rise by up to 4% by late this year. Those numbers sound small. They are not. In a tail risk scenario, defaults could double those estimates, cutting off funding for many companies and triggering a credit crunch in loan markets. CNBC. A credit crunch is the engine that turns a slowdown into a recession. When credit freezes, healthy companies cannot refinance maturing debt. They cut spending, they lay off workers, the slowdown deepens. The connection between artificial intelligence enthusiasm and the broader financial system is not obvious to most observers. The headlines are about new model releases and benchmark scores. The actual risk is in the loan books of large American banks and the structured credit funds that have flowed alongside them. The bet is enormous. The exposure is concentrated. The cushion is thinner than it looks. Whether the bet pays off depends on whether the productivity gains from artificial intelligence arrive fast enough to justify the spending. If they do, the build-out becomes the next great economic transformation. If they do not, it becomes the trigger. There is a part of the financial system most people have never heard of, and most people are not supposed to. It is called private credit. It is enormous. It is largely unregulated. And it has grown faster in the last decade than almost any other corner of finance. Private credit is exactly what it sounds like, lending that happens outside the public bond market and outside the traditional banking system. A company needs money. A private credit fund lends it. The loan is private, meaning it is not traded on a public exchange. The borrower is private, meaning it is not a publicly listed company. The terms are negotiated directly between the lender and the borrower, without the disclosure requirements that come with public markets. The private credit market is now estimated at roughly $2 trillion. Leveraged loans, a related and similarly opaque corner, total another $1.5 trillion. Combined, that is $3.5 trillion of corporate debt sitting in markets that almost no regulator can fully see. CNBC. To put that number in perspective, the entire American banking system holds about $23 trillion in assets. Private credit and leveraged loans together represent about 15% of that total. They are no longer a niche. They are a parallel banking system doing many of the same things banks do, with fewer rules and less oversight. How did this happen? After the financial crisis, regulators tightened the rules on traditional banks. Banks were required to hold more capital. They were forced to reduce risky lending. The result was predictable. Riskier borrowers, the ones banks could no longer serve, went looking for credit elsewhere. Pension funds, insurance companies, and asset managers stepped in. They created private credit funds. They lent the money the banks no longer would. For years, this worked beautifully. Returns on private credit were strong. Default rates were low. Pension funds and endowments piled in, hungry for yield in a world where bonds paid almost nothing. The market grew exponentially. Then, interest rates rose. The cost of capital for borrowers doubled or tripled. Many of the loans were structured with floating rates, meaning their payments rose alongside the Fed's hikes. Borrowers who had taken on debt at 3% suddenly had to service it at 8 or 9%. Some could handle the increase. Many could not. The default story has been quiet so far. Defaults in private credit have ticked up, but not exploded. The funds have used various techniques to avoid recognizing losses. They restructure loans. They extend maturities. They convert debt to equity. They mark assets at values the market would not actually pay. The official numbers look manageable. The unofficial picture is harder to read. Because these markets are private, there is no real time price discovery. Nobody knows what the loans are actually worth until somebody tries to sell. And nobody wants to sell into a weak market, so the real values stay hidden. This is the structural problem. Private credit, by design, is illiquid and opaque. That works fine when conditions are good. It becomes dangerous when conditions deteriorate. The funds cannot mark their positions to market because there is no market. Investors who want to redeem cannot because the funds have gates and lockups. The losses, when they finally surface, tend to surface all at once, in cascades. A meaningful share of private credit has flowed into private equity-owned software and data services firms. Many of these firms carry significant debt relative to revenue. They were leveraged up during the cheap money era on the assumption that growth would continue. Growth has slowed. Some are now in trouble. If artificial intelligence disruption hits this segment hard, the private credit losses could be substantial. The funds would have to mark down their portfolios. investors would demand redemptions. The funds would scramble to sell what they could, pushing prices lower, forcing more markdowns. A liquidity spiral in a market that nobody has ever stress-tested at scale. The shadows are quiet now. Shadows usually are, until they are not. Walk into a casino. Find the biggest table. Watch the 4 largest stacks of chips. Now imagine that for the entire stock market. Microsoft, Apple, Nvidia, Alphabet. Add Amazon and Meta and you have 6. Together, these companies represent an outsized share of the entire American stock market. The exact percentages shift week to week, but the concentration has been at historic highs for over a year. Roughly 30% of the S&P 500's value sits in fewer than 10 companies. When the index goes up, it is usually because these companies went up. When the index goes down, it is usually because they did. The other 490-something companies are passengers. The mega caps are the engine. This concentration is not new in absolute terms. Markets have had concentrated leadership before. The Nifty 50 era of the late 1960s, the technology boom of the late 1990s. Both ended badly. Concentration is not always a bubble signal, but it is always a fragility signal. When a small number of companies are holding up the index, anything that hurts those companies hurts the index disproportionately. What makes the current concentration particularly concerning is what is driving it. The mega caps are leading because of artificial intelligence enthusiasm. Their valuations have expanded on the assumption that AI will generate enormous future profits. Their capital expenditure is funding the AI build-out described in the previous chapters. Their stock prices are simultaneously the cause and the consequence of the AI investment boom. That circular relationship is the kind that bubbles are made of. The companies invest heavily in AI. The investment justifies higher valuations. Higher valuations make their stock more valuable as currency for further investment. The stock funds more investment. Each turn of the cycle assumes the previous one was justified, and the entire structure rests on the assumption that the AI revenue will eventually arrive to validate it. If revenue underwhelms, the unwinding is mathematically nasty. Each company has to revisit its capex assumptions. Earnings projections fall. Valuations compress. The compression hits the index hard because of the concentration. Index funds, which now hold the majority of all American retirement savings, get dragged down with them. Pension funds. 401ks. The effect ripples into every household with retirement savings, regardless of whether those households ever bought a single technology stock directly. There is a separate concern about market structure. The rise of passive investing has changed how stocks behave. When investors put money into an S&P 500 index fund, the fund must buy all 500 stocks in proportion to their weight. The mega caps, being the biggest weights, get the biggest share of every dollar that flows in. This creates a self-reinforcing loop. As index funds grow, the biggest stocks grow faster than the smallest. The top of the market expands relative to the bottom, mechanically, regardless of underlying fundamentals. In a downturn, the same mechanism works in reverse. Outflows from index funds force selling of the biggest stocks first. The mega caps fall harder than the smaller stocks they have been outperforming. The mechanical force that lifted them on the way up amplifies the fall on the way down. Goldman Sachs and other major banks have been raising warnings about market concentration for over a year. The warnings have been ignored, mostly because the concentration has kept paying off. Investors who got cautious early have underperformed. The penalty for being wrong about a bubble before it pops is enormous. Most professionals would rather ride the bubble than risk losing their jobs by stepping aside too early. This is how bubbles always last longer than seems reasonable. The incentives align towards staying in until the very last moment. Then, the unwinding happens fast. The American stock market today is not just expensive. It is expensive in a way that depends on a small number of companies continuing to deliver growth that depends, in turn, on assumptions about artificial intelligence that have not yet been proven. That is a precarious foundation for what is now most of the country's retirement wealth. Every quarter, American corporations report their earnings. Most reports pass without much drama. A few exceed expectations and the stock pops. A few miss and it drops. The aggregate moves the index a little and the cycle continues. Right now, the cycle is a tightrope. The stocks that have driven the market higher are priced for perfection. Their price-to-earnings ratios assume continued aggressive growth in revenue, profit margins, and capital efficiency. There is almost no margin for disappointment built into the prices. A modest earnings miss from one of the mega caps could trigger a meaningful correction in the index, because the index is now so concentrated in their performance. This is what professionals mean when they talk about valuation risk. It is not that the companies are bad. Most of them are extraordinary businesses with real moats and real cash flow. The risk is in the price being paid for those businesses. Even great companies become bad investments at the wrong price. History offers some uncomfortable parallels. Cisco Systems was the most valuable company in the world at the peak of the dot-com bubble. Its products went on to become the literal infrastructure of the internet. The company never disappeared. It still exists, still generates billions in profit. But anyone who bought Cisco stock at the peak in March of 2000 has not made a positive return in the following 25 years. The company succeeded. The investment, at that price, did not. The same risk exists today with the artificial intelligence leaders. Whether AI ultimately transforms the economy is one question. Whether the current stock prices reflect the realistic financial returns of that transformation is a different question. The answers can diverge for a long time. The catalyst for a correction usually arrives unexpectedly. It is rarely a single dramatic event. More often, it is a gradual erosion of the narrative that supported the high prices. An earnings call where the chief executive sounds slightly less confident. A research report that questions the timing of revenue ramps. A new competitor that turns out to be more capable than expected. A regulatory action. Each individual event would be insignificant in a normal market. In a market priced for perfection, any one of them can be the spark. The current quarter's earnings season has been mixed. Some of the AI-adjacent companies have beaten expectations. Some have hinted at slower growth ahead. The market has so far chosen to focus on the beats and dismiss the warnings. That selective attention works until it does not. There is also a layer of professional positioning that amplifies the risk. Hedge funds and institutional investors have crowded into the same trades. Long the AI leaders, short or underweight the rest of the market. When professional positioning becomes that one-sided, any reversal force is unwinding. The unwinding becomes its own selling pressure, separate from the original catalyst. This is the mechanic that turns a normal pullback into a sharp correction. Crowded trades unwind violently because everyone tries to get out at the same time. The first sellers find buyers. The second wave finds fewer. By the third wave, prices have moved enough to trigger forced selling from leveraged positions, and the cascade accelerates. There is a specific name for what happens when concentration meets crowded positioning, meets a high valuation. Markets call it a melt-up, followed by a meltdown. McInnes at US News told reporters that a more likely scenario than recession is a potential market melt-up, where stock prices accelerate rapidly above what fundamental analysis suggests they are worth. A 25% move higher over the next year would, in his framing, indicate an unsustainable melt-up. US News and World Report. Melt-ups feel great while they happen. They are the parties before the hangover. The trouble is recognizing them in real time. From the inside, a melt-up looks indistinguishable from a continuation of the bull market that preceded it. The signs only become obvious in retrospect. If the catalyst arrives this quarter or next, the correction could be severe. Not because anything fundamental has changed, but because the prices need to come down to where the math works. Which brings the conversation to the next pressure on those prices. Oil. The single biggest external shock hitting the global economy right now did not come from a central bank or a market panic. It came from the Middle East. Brent crude has surged to $112.57 per barrel. The price has more than doubled from where it sat a year ago. Gasoline at the pump has followed, diesel has followed, jet fuel has followed. Every product that depends on oil to be made, moved or used has gotten more expensive. Techie. For households, the math is direct. Filling up a typical SUV that used to cost $50 now costs $80 or more. Heating oil for the houses that still use it has spiked. Plastic goods, which use petroleum as a feedstock, are getting more expensive. Air travel is more expensive because jet fuel is more expensive. Shipping is more expensive because diesel is more expensive. Anything that has to be moved by truck, train, or ship is feeling the upstream cost. For the broader economy, the math is more complicated. Oil shocks have a long history of breaking expansions. The 1973 embargo triggered the worst stagflationary period in modern American history. The 1979 Iranian Revolution did the same on a smaller scale. The 2008 oil spike contributed to the financial crisis. Every time oil has gone up sharply and stayed up, a recession has followed. The mechanism is straightforward. Energy is an input to almost everything. When energy prices rise, the cost of producing other goods rises. Producers either pass the cost through, which raises consumer prices and squeezes household budgets, or absorb the cost, which compresses corporate profit margins. Both outcomes are negative for growth. The current situation has a unique twist. The United States is now energy independent in a way it was not in 1973. American shale oil production is enormous. The country is a net exporter of oil and gas. However, oil is a globally priced commodity. Even domestically produced crude reprices to reflect global supply disruptions. The benefit of energy independence is strategic, not economic, in a supply shock scenario. Techie. That is a critical point that gets missed in political conversations about energy policy. American producers cannot simply choose to sell their oil for less than the global price. They sell at the market price, which is set by global supply and demand. When global supply falls, domestic prices rise to match, regardless of how much oil America produces. The shock is also feeding inflation in ways that complicate Federal Reserve policy. The Fed has been trying to engineer a soft landing, cut rates enough to support the economy, not so much that inflation reignites. The oil shock makes that balance harder. If the Fed cuts aggressively to support the economy, inflation gets worse from the energy side. If the Fed holds rates steady to fight inflation, the economy weakens further. There is a phrase economists use for this kind of trap. Stagflation. It is the combination of stagnant growth and persistent inflation. It is the worst possible macroeconomic environment because the standard tools do not work. Cutting rates makes inflation worse. Hiking rates makes the recession worse. The economy gets squeezed from both sides at once. The closest historical analogue to the current situation is not 2008 or 2020. It is 1973. An oil shock driven by Middle East conflict, a Federal Reserve already behind the inflation curve, a weakening dollar amplifying the inflationary pressure. The combination produced a decade of economic difficulty in the 1970s. The same combination is forming now. Whether oil stays at 112 depends on geopolitics that no economist can predict. If the conflict escalates, oil could spike further. If a settlement emerges, prices could fall back toward 80. The range of outcomes is enormous, and the economy has to plan for the worst case while hoping for the best. The next chapter looks at the second shock, running alongside the oil shock. Tariffs. Tariffs work slowly, and that slowness is part of what makes them dangerous. A consumer feels gasoline prices the day they change. A consumer feels tariffs months or years after they are imposed. when the goods they were applied to finally show up on store shelves at higher prices. The current tariff regime has been ratcheting up for over a year. Tariffs on Chinese goods, tariffs on European goods, tariffs on Mexican and Canadian goods, tariffs on specific industries, tariffs on specific products. Each round adds friction to global trade and adds cost somewhere along the supply chain. The cost pass-through has been gradual and uneven. Some industries absorbed the tariffs in the form of squeezed profit margins, others passed them on. Some routed around them by shifting suppliers, often at the cost of efficiency. The aggregate effect is that consumer goods, especially durable goods, have gotten more expensive than they would have been without the tariffs, but the increase has been spread across many quarters. Some economists argue that tariffs are simply a tax on consumers, paid in the form of higher prices for imported goods. Others argue that tariffs incentivize domestic production and ultimately strengthen the economy by shifting jobs back home. Both views contain truth. Tariffs do raise consumer prices in the short term. They also do sometimes cause production to relocate. The question is whether the long-term gains outweigh the short-term costs. Right now, the short-term costs are showing up. Manufacturing employment has not surged the way tariff supporters predicted. The Trump administration's policies aimed at reshoring production have not produced a measurable boom in domestic factory hiring. Manufacturing employment has been roughly flat for over a year, despite tariffs aimed at reshoring jobs from overseas. 12,000 manufacturing jobs were lost in February alone. CNBC. The reasons are structural. Building factories takes years. Equipping them takes more years. Training workers takes additional time. Even if a tariff successfully incentivizes a company to move production back to the United States, the actual jobs do not appear for a long time. Meanwhile, the immediate cost of the tariff hits consumers right away. There is also the issue of retaliation. When the United States imposes tariffs, trading partners often impose tariffs of their own. American exports get more expensive in their target markets. American farmers, manufacturers, and service providers lose business. Soybean farmers in particular have struggled as Chinese tariffs reduced their largest export market. Boeing has lost orders. American whiskey distillers have seen European sales fall. The aggregate effect is smaller global trade, less efficiency, higher prices, slower growth. None of these effects is dramatic on its own. Together they form a drag on the economy that compounds quietly. The Federal Reserve has acknowledged the tariff impact in its statements. Sticky inflation, the kind that does not respond to monetary policy, is partly a tariff story. Core personal consumption expenditures inflation remained at 3% in December on an annual basis. 3% is above the Fed's 2% target. The gap has persisted longer than the Fed expected. Tariffs are part of why. US News & World Report. The political dynamics make the situation more difficult. Tariffs are popular in some communities, especially those that have lost manufacturing jobs over the last few decades. The promise of bringing those jobs back is real to people who lived through the closures. The political incentive is to maintain or expand tariffs, even when the economic case is mixed. There is also the matter of timing. The United States and China negotiated a 12-month truce that has held through early 2026. The truce theoretically leaves tariffs and export controls unchanged for much of this year. However, the truce remains fragile, and any miscalculations along the way could derail the deal. If the truce breaks, tariffs could spike further, reigniting inflation and triggering retaliatory escalation. Ng think the tariff story is a slow story. It does not move markets the way a Federal Reserve decision does, but it grinds away at consumer purchasing power, at corporate margins, at global trade, month after month. Over time, the grinding adds up. It is one of the persistent reasons inflation has not fallen back to 2% and shows little sign of doing so soon, which puts the Fed in an impossible position. Imagine a doctor with a patient running both a high fever and severe hypothermia at the same time. Treating one symptom makes the other worse. There is no medicine that helps both conditions simultaneously. The doctor has to choose which symptom is more dangerous and treat that one, knowing the other will get worse. That is the position the Federal Reserve is in. Inflation is sticky. Oil prices are rising. Tariffs are pushing goods prices up. Wage growth, while slowing, is still elevated. The Fed's mandate to maintain price stability says it should keep rates higher. Unemployment is rising. Job growth has gone negative. The leading economic index has been falling for 19 months. The labour market is weakening. The Fed's mandate to maintain maximum employment says it should cut rates aggressively. The two mandates are pulling in opposite directions for the first time in a generation. The Fed cannot satisfy both. For the last 6 months, the Fed has chosen the middle ground. It cut rates 3 times in late 2025. It paused after that. The Federal Open Market Committee held rates steady at its January and April meetings after the 3 cuts brought the target range to 3.5 to 3 3 quarters percent. The pause reflects the genuine difficulty of the choice. US News and World Report. The internal Fed deliberations have become more contentious as the data has worsened. Some members want to cut faster to support the labour market. Others want to hold or even hike to prevent inflation from re-accelerating. The committee has been split. The pause is partly a compromise, partly an acknowledgement that nobody knows the right answer. The political environment has made the Fed's job harder. The administration has been publicly pressuring the Fed to cut more aggressively. The Fed has formally resisted that pressure. But the pressure exists, and it complicates the optics of every decision. A cut now might be interpreted as political. A hold might be interpreted as defiance. Neither pure technocratic decision-making is fully possible. There is also the matter of fiscal policy. The federal government is running enormous deficits. The interest cost on the national debt has become a major budget item. When the Fed keeps rates high, the cost of servicing that debt rises, putting pressure on the government's finances. There are some economists who argue the Fed will eventually be forced to cut rates, not because the economy demands it, but because the Treasury cannot afford the alternative. The historical record on Fed decisions in stagflationary environments is not encouraging. The 1970s are the closest analogue. The Fed at the time, under Arthur Burns, kept rates too low for too long, allowing inflation to embed itself in the economy. By the time Paul Volcker took over and raised rates dramatically, the country had to endure a deep recession to break the inflationary spiral. The lesson from that era was that delay made the eventual pain worse. The current Fed knows this history. They have been more willing to keep rates higher than the labour market would suggest precisely because they remember what happened in the 70s. But the labour market is now weakening fast enough that the cost of staying restrictive is becoming visible. Each month of weak job growth makes the case for cutting stronger. There is one more variable that complicates everything. Whether the Fed cuts rates aggressively or not, the cuts may not have their usual effect. Long-term yields have stayed elevated. Mortgage rates have not fallen as much as Fed cuts would normally produce. Bank lending standards have continued to tighten. The transmission of monetary policy to the real economy is weaker than in past cycles. This means even if the Fed decides to act, the effect of its actions will be muted. The economy needs more stimulus than the Fed can easily provide through its standard tools. Quantitative easing, the policy of buying long-term bonds to push yields lower, is technically available, but the Fed has been cautious about reactivating it given the inflation. Backdrop. The Fed is cornered, the economy is sliding, the tools are partial, the choice is impossible. What it ultimately decides will shape the trajectory of the next 18 months more than almost any other single factor. Markets are watching every word. Inflation behaves like sand in a kitchen. You can sweep most of it up, but a layer always remains. It hides in the grout. It works its way back into the corners. No matter how clean the floor looks, run a finger along the baseboards and the sand is still there. The inflation that came roaring out of the pandemic has mostly been swept up. The headline numbers came down from peaks above 9% to a more manageable range. The Fed's preferred measure, core personal consumption expenditures, has settled into a stubborn band around 3%, not the 2% target, not anything close to disaster. But not falling further either. This stickiness is the part the Fed cannot solve with rate decisions alone. The reasons for the stubbornness are layered. Services inflation, especially in housing and healthcare, has remained elevated. Wage growth, while slowing, is still rising at a pace inconsistent with 2% inflation. Tariffs are adding to goods prices. Insurance costs have exploded due to climate risks and rising medical care. Energy prices are climbing again. Each individual factor is small. Together they form a flaw that monetary policy cannot easily push through. Housing inflation is particularly sticky because of how it is measured. The official inflation number uses something called owner's equivalent rent, which estimates what homeowners would pay to rent their own homes. This measure lags actual market rents by 12 to 18 months. Even when market rents stop rising, the official measure keeps reporting elevated rent inflation for over a year. The lag has been keeping the headline number stubbornly high. Healthcare inflation has its own dynamics. Insurance premiums tend to rise in annual cycles, regardless of broader economic conditions. Drug prices, while controlled in some categories, continue to rise in many others. Hospital costs have climbed steadily for decades. The healthcare share of consumer spending keeps growing, and it inflates faster than most other categories. Then there is the wage component. Workers have, finally, gotten meaningful raises after decades of stagnation. Real wages, adjusted for inflation, have risen modestly over the last 2 years. Those raises are good for workers. They are also a source of ongoing inflationary pressure. Companies that pay higher wages either accept lower margins or pass costs to consumers. Most pass. The Federal Reserve faces a difficult question. Is 3% inflation acceptable given the labour market weakness, or does it need to push harder to get back to 2%? There has been public debate among economists about whether the 2% target itself should be raised. Some argue that 2% was an arbitrary choice, that 3% is just as economically functional, and that fighting for the last percentage point may not be worth the cost in lost employment. The official Fed position is that 2% remains the target. Privately, many economists suspect the Fed will end up tolerating 3% for an extended period, because the alternative is too painful to pursue. This unofficial accommodation, if it happens, would be a tacit admission that monetary policy has limits in an environment of supply shocks, tariffs, and structural cost pressures. There is also the question of what stays in the inflation calculation. Some categories that drove the post-pandemic spike have already stabilised. Used car prices after spiking have come back down. Goods inflation has largely normalised. The pressure now is concentrated in services, where the Fed's tools are less effective. Cutting rates does not lower a hospital bill. It does not reduce an insurance premium. It does not bring down rent in a city where the housing supply is constrained. The implication is uncomfortable. Inflation may not return to 2% for years. The Fed will keep saying it is targeting 2%, but actual outcomes will hover above it. Households will continue to feel that the cost of living is rising faster than they think it should. Investors will price assets accordingly. A persistent 3% inflation environment has consequences for everything else. Long-term bond yields stay elevated. Mortgage rates stay elevated. Pensions struggle to keep up with the rising cost of living. The real return on cash savings remains negative, eroding purchasing power slowly but steadily. This is the flaw the Fed is fighting against. The bond market, which is sometimes called the smart money, is calling the flaw. The bond market is the largest and most important market in the world, and it is the one most people pay the least attention to. Stocks get the headlines. Bonds set the rules. What bonds price tells you what the world thinks about inflation, growth, and risk over the next 2, 10, or 30 years. Right now, the bond market is sending warnings that the equity market has chosen to ignore. The 10-year Treasury yield sits at 4.39%. The 2-year Treasury yield sits at 3.88%. The 10-year is well above where it was a year ago. The level itself is informative. It means the market is demanding a relatively high yield to lock up money for 10 years. Polymarket. Why? There are a few possible answers. The market might expect inflation to remain elevated. Higher expected inflation pushes nominal yields up because investors want compensation for the loss of purchasing power. The market might expect the United States government to issue enormous quantities of debt. Higher supply of bonds pushes yields up because investors need to be compensated for absorbing the supply. The market might expect default risk to be rising, however gradually. Higher perceived credit risk pushes yields up because investors want compensation for the chance of loss. Some combination of all three is probably the answer. The federal deficit is enormous. Inflation has been sticky. Foreign demand for American debt has weakened, with central banks in China, Japan, and elsewhere either buying less or even selling. Each factor adds upward pressure to yields. The implications for the broader economy are direct. Mortgage rates track the 10-year Treasury. When the 10-year stays at 4.4%, the 30-year mortgage stays around 6.8%. That is the level that has frozen the housing market. As long as the 10-year does not fall meaningfully, mortgage rates will not fall meaningfully, and housing will not unfreeze. Corporate borrowing follows a similar pattern. Companies issuing bonds pay a spread above the Treasury yield based on their credit rating. When Treasury yields stay high, all corporate borrowing stays expensive. Companies that need to refinance maturing debt find themselves rolling over at much higher rates than they were paying before. The interest expense rises, profits get squeezed. The pressure adds another headwind to corporate earnings. The dollar plays into this story as well. The American dollar has been strong relative to most major currencies for several years. A strong dollar is good for American consumers buying imports, but bad for American exporters, who find their goods more expensive in foreign markets. It also exports inflation to other countries, since commodities priced in dollars become more expensive in their local currencies, which can destabilize emerging economies. Dependent on dollar-denominated trade. Lately, the dollar has shown signs of weakness. Some investors are concerned about the size of the federal deficit. Some are concerned about political instability around Fed independence. Some are simply rotating into other currencies and hard assets. A weaker dollar would be inflationary in the short run, since imports would cost more, but might also relieve pressure on American exporters and emerging markets over time. The deficit deserves a paragraph of its own. The federal government is now spending more on interest payments than on defence. The interest cost is the fastest growing line item in the federal budget. As long as Treasury yields stay elevated, the cost will keep growing. Eventually, this becomes a fiscal sustainability question. Not in the sense that the government will default. The Federal Reserve can always print enough dollars to prevent that. But in the sense that paying the interest crowds out other spending and creates pressure for either tax increases or further inflation. The bond market sees all of this. It is pricing for it. The yield curve, the level of yields, the dollar's behaviour, the spreads on corporate bonds, all reflect a market preparing for outcomes that the equity market has not yet. Acknowledged. When the bond market and the equity market disagree this much, history says the bond market wins. Equities are about hope. Bonds are about cash flow and survival. The cash flow people are signalling caution. History never repeats. It rhymes. The trick is finding the right rhyme. For most of the last few decades, when economists wanted to compare a downturn to history, they reached for 2008 or 2020. Both were fresh. Both were memorable. Both had clear narratives. A financial crisis. A pandemic. The current moment looks like neither of those. The closest historical analogue to 2026 is 1973. Both episodes share the same DNA: an oil supply shock driven by geopolitical conflict in the Middle East, a Federal Reserve that was already behind the inflation curve, a weakening dollar that amplified the inflationary impulse. Techie. The list of similarities is uncomfortably long. 1973 saw an oil embargo by Arab producers in response to Western support for Israel during the Yom Kippur War. Oil prices quadrupled, gas lines wrapped around blocks, stagflation set in. The next decade saw 2 recessions, persistent inflation, and a profound erosion of middle-class purchasing power. 2026 is seeing a similar oil shock from a different but related Middle Eastern conflict. Prices have not quadrupled, but they have more than doubled from recent lows. The pattern of supply disruption, sticky inflation, and deteriorating consumer confidence is the same. 1973 came after a long period of asset price appreciation. The 1960s bull market in stocks. The expansion of consumer credit. The first wave of post-war suburbanization. The growth had been real, but had accumulated excesses that needed to correct. 2026 is following a similar long expansion. Stock prices near record highs after a decade of nearly uninterrupted growth. Real estate values that doubled in many markets between 2012 and 2022. Asset prices well ahead of where wages and productivity would justify. 1973 saw the end of the post-war dollar standard. The Bretton Woods system, which had pegged currencies to the dollar and the dollar to gold, collapsed. The world transitioned to floating exchange rates. The transition added uncertainty to global trade and investment. 2026 is seeing increasing fragmentation of the dollar-based financial system. China, Russia, and other countries are slowly reducing their dollar holdings. Alternative payment systems are being developed. The dominance of the dollar is not collapsing, but it is slowly fading. A multipolar monetary system is emerging. The most important similarity is the structural one. Both periods feature simultaneous supply shocks, demand weakness, and policy constraints. The Fed in 73 could not cut rates aggressively because of inflation. The Fed today faces the same constraint. Fiscal authorities in 73 could not provide major stimulus because of debt levels and inflation worries. The same constraint applies now. There is one critical difference. In 73, the United States was much more dependent on Middle Eastern oil. Domestic production was limited. Today, American shale provides a buffer. The country can produce its own oil, even if it cannot escape global pricing. This difference matters at the margin, but not as much as it sounds. Oil is a globally priced commodity. The benefit of energy independence is strategic, not economic, in a supply shock scenario. Even with shale, gasoline prices in America move with global oil prices. Techie. The lesson from 73 is sobering. The recession that began in late 1973 lasted 16 months. Inflation took years to bring under control. The misery index, which combines inflation and unemployment, reached levels not seen before or since. Real wages fell. The country's confidence in its institutions was badly damaged. The recovery, when it came, required deeply painful policy. Paul Volcker raised interest rates to nearly 20% in the early 80s. Unemployment spiked into double digits. The country endured another recession, deliberately engineered, to break the inflationary cycle for good. Only after that pain did the long expansion of the 80s and 90s become possible. The decade-long aftermath is the part that scares historians. A short, sharp recession is bad. A long stagflationary slog is much worse. The damage to households, businesses, and political institutions is harder to repair. If 2026 rhymes with 73, the country could be looking at not a single recession, but a difficult era. Years, not months, of subpar growth, persistent inflation, and political polarization. The headlines would change. The underlying conditions would not. History does not promise this is what comes. It only suggests it is plausible. There is a different historical echo, more recent and even more uncomfortable. 2007. In September of that year, almost no one in the financial press was talking about an imminent crisis. The stock market was near record highs, the economy was growing, the unemployment rate was in the low fives. Most economists predicted continued expansion. Some were starting to mention housing weakness, but the consensus view was that the housing problems would be contained. The Moody's recession model, which has correctly preceded every recession since 1945 once it crossed 50%, sat just under 50 in September 2000. 7. The last time it was that high outside of an actual downturn. Techie. That September, looking back, was the calm before the storm. Bear Stearns was still a respected investment bank. Lehman Brothers was still considered too big to fail. The interbank lending market was still functioning. The mortgage market was showing strain, but the strain was not yet systemic. Within a year, all of that had changed. Bear Stearns was bought for $10 a share by JP Morgan. Lehman Brothers had filed for bankruptcy. The interbank market had frozen. The Federal Reserve had cut rates to zero. The Treasury had committed hundreds of billions to bank bailouts. The country was deep in the worst recession since the Great Depression. The trajectory from September 7 to September 8 took only 12 months. 12 months from looking fine to looking shattered. The parallels to today are not perfect, but they are present. A long expansion, stretched valuations in some asset classes, rising debt loads in specific sectors, tightening credit conditions, yield curve uninversion, leading economic indicators falling, consumer sentiment in concerning territory. None of these signals are screaming, all of them are blinking. The specific risk profile in 2026 is different from 2007. The financial system is better capitalized. Banks hold more capital. Stress tests are more rigorous. The kind of unregulated subprime mortgage market that fueled the prior crisis does not exist in the same form today. The rotten core of the previous crisis has been mostly addressed. But every crisis is unique. The next one will not look exactly like the last one. It will rhyme, but the rhyme will be different. The risks today are concentrated in different places. Artificial intelligence-related lending, private credit, sovereign debt levels, concentration of stock market value in a few mega-cap names, geopolitical fragmentation. These are the new pressure points, and most of them have not been stress-tested at scale. The way crises happen is also worth thinking about. They tend to emerge from places that nobody is watching. The mortgage market in 2007 was being watched by some, but the specific mechanism of the crisis, the way mortgage defaults could cascade through derivatives and collateralized debt obligations into the entire banking system, was not well understood by most participants. The interconnections were the problem. The interconnections were largely invisible until they snapped. Today, the interconnections may be hiding in places like artificial intelligence-related leveraged loans, or in private credit, or in the dependencies of the major hyperscalers on each other and on the broader semiconductor supply chain, or in sovereign bond markets that have not yet had to absorb a major test of demand. The point is not that any of these is definitely the trigger. The point is that the trigger usually comes from somewhere unexpected. What can be said with confidence is that the warning signs today resemble the warning signs of 2007 more than they resemble the warning signs of healthy expansions. The Moody's model at 49%. The leading indicators falling for 19 months. The yield curve uninversion. The slowing labour market. The consumer sentiment at recession levels. The geopolitical shocks. Each one alone might be navigable. Together they form a configuration that has historically preceded the kind of cycle nobody wants. History does not guarantee the rhyme will play out, but it suggests caution is warranted, even when the cable news cycle treats every update as proof of resilience. Step further back. To 1929. The lesson of 1929 is not that all stock market crashes lead to depressions. Most do not. The lesson is more specific. When asset bubbles burst alongside real economy weakness, the combination is uniquely dangerous. The 1929 crash on its own was bad. The Dow lost about a quarter of its value in a few days. That kind of decline, in isolation, would have been painful but recoverable. Markets had crashed before. They have crashed since. Most crashes get absorbed within a year or two. What turned the 29 crash into the Great Depression was the combination of a stock market collapse with a banking crisis, with an agricultural depression with a global trade collapse with a deflationary spiral. Each problem amplified the others. Banks that had lent against stocks collapsed when the stocks did. Depositors panicked and withdrew funds. More banks collapsed. Credit froze. Unemployment soared. Prices fell. Companies cut wages. Consumers cut spending. The cycle fed itself. The depression deepened in part because the policy response was inadequate. The Federal Reserve actually raised rates in the early 30s, fighting an imagined inflation, while the real risk was deflation. The Smoot-Hawley Tariff Act, passed in 1930, raised import duties and triggered retaliation that crushed global trade. Banks that should have been recapitalized were allowed to fail. The combination of policy errors compounded the underlying crisis. The lesson for today is not that 1929 will repeat. The lesson is about the danger of compounding shocks. Right now, the American economy faces several potential shocks at once. An asset bubble in artificial intelligence-related stocks. A credit cycle that is deteriorating. A geopolitical environment generating oil supply risks. A tariff regime adding to costs. A federal deficit that constrains fiscal response. A Federal Reserve already partially constrained by sticky inflation. Banks with concentrated exposure to a single thematic bet. If only one of these shocks materializes, the system can probably absorb it. Markets correct. The Fed cuts. Stimulus is provided. Recession is shallow and short. If 2 or 3 shocks happen simultaneously, the math changes. The Fed cannot cut aggressively because of inflation. Fiscal stimulus is constrained by debt levels. Asset prices fall. Credit tightens. Unemployment rises. Each problem makes the others harder to address. The risk of compounding shocks is what historians call systemic risk. It is the kind of risk that builds quietly, becomes visible suddenly, and cascades through the entire system before policymakers can respond. There are reasons to think the modern system is more resilient than the system of 1929. Bank capital requirements are dramatically higher. Deposit insurance prevents the kind of bank runs that destroyed the system in the early 30s. The Federal Reserve is willing to act as a lender of last resort, and has demonstrated that willingness repeatedly. Globalization, despite recent fragmentation, still provides more diversification than was available in the 30s. There are also reasons for concern. The interconnections in the modern financial system are more complex than they have ever been. Derivatives, repo markets, money market funds, shadow bank, each of these adds efficiency to the system. Each also adds fragility. The crisis of 2008 emerged from these interconnections in ways that nobody had fully anticipated. The new interconnections around artificial intelligence and private credit are even less well understood. The system has not been stress tested through a real downturn since these areas became significant. Whether they will hold up gracefully or break in unexpected ways is something nobody can know in advance. What the lesson of 1929 teaches is humility about complex systems under stress. The combination of pressures that turns a manageable correction into something worse is hard to predict. The early signs are usually present but easy to dismiss. The cascade, when it begins, moves faster than the policy response. The current configuration of the American economy contains enough pressure points that the chance of compounding shocks is not negligible. Whether they actually compound depends on a lot of factors, many of which are outside any single policymaker's control. Geopolitics. Earnings results. Commodity prices. Corporate decisions. Each one affects the others. The next chapter zooms back from history to the present and asks what a manageable downturn could actually look like. For all the warnings, recession is not the only possibility. The economy could thread the needle. A soft landing remains technically achievable. Some economists still believe it is the most likely outcome. A soft landing is what the Federal Reserve has been trying to engineer since rate hikes began. Cool inflation without crashing the labour market. Slow growth enough to take the heat out of prices, but not so much that unemployment spikes. The historical track record on soft landings is poor. The Fed has only successfully achieved one cleanly in modern history, in the mid-1990s. Whether 2026 joins that shortlist depends on a lot of factors aligning at once. The first factor is the labour market. A soft landing requires unemployment to rise modestly without spiralling. Some increase from current levels is acceptable. A jump to 5.5% or 6% would still be consistent with a soft landing if it happened gradually. A sudden spike above 6.5% would push the economy into recession territory, regardless of what the Fed does. The second factor is inflation. The path requires core inflation to drift back toward 2% without the Fed needing to engineer a recession to get there. Sticky 3% inflation would not be ideal, but it might be tolerable if the trajectory is downward. Rising inflation would force the Fed to either keep rates higher than the economy can withstand, or accept higher inflation as the new normal. The third factor is the artificial intelligence build-out. A soft landing requires the AI boom to continue providing meaningful capital expenditure stimulus without bursting into a destructive bubble collapse. The build-out could moderate rather than collapse, gradually cooling as productivity gains catch up with infrastructure spending. That moderation, if it happens, would be growth supportive without being destabilizing. The fourth factor is geopolitics. Oil prices need to stabilize or decline rather than continuing higher. The Middle East conflict needs to either resolve or contain itself rather than escalating. Tariff tensions with China need to remain in their current truce rather than breaking. Each of these is outside Federal Reserve control. Each is critical to the soft landing scenario. The fifth factor is consumer behaviour. Households need to keep spending at moderate levels even as sentiment remains weak. Some pullback is expected and even desirable. A complete spending freeze, especially in discretionary categories, would tip the balance toward recession. The K-shaped split actually helps this scenario, since the top half of households retains plenty of capacity to spend even if the bottom half retrenches. If all these factors break favourably, the next 18 months could see a meaningful slowdown, but not an outright recession. Growth could fall to 1% or below for several quarters. Unemployment could rise to 5% or so. Inflation could drift toward 2.5%. Stocks could correct moderately, perhaps 15 to 20% from peaks, before resuming their long-term upward trajectory. Households would feel pinched. Businesses would feel cautious. The recession alarm bells would quiet without ever fully ringing. This scenario is not impossible. Some forecasters, like Goldman Sachs at 30% recession probability, are still betting on a version of it. The Goldman Equity Strategy team has coined the TACO framework, arguing that markets have over-discounted the impact of trade policy on corporate earnings, and that tariffs will prove cyclical and overpriced. The thesis, if correct, would support a soft landing outcome. Techie. There are also genuine bullish factors that get less attention than they deserve. Productivity growth has been surprisingly strong in some sectors. Corporate balance sheets, in aggregate, are healthier than before previous recessions. Households who own homes have substantial equity buffers, even if those who do not own are struggling. Bank capital levels are robust. Deposit insurance prevents bank runs. The financial system is more resilient than it was in 2007. The argument for soft landing is not delusional. It is a real possibility. The trouble is that it requires many independent variables to break favourably at the same time. The historical base rate for that kind of alignment is low. Recessions, when conditions are this stretched across this many fronts, are simply more likely than not. A soft landing requires luck. Right now, the economy needs more than the usual amount. If the soft landing scenario requires luck, the hard landing scenario requires only the absence of intervention. The chain of events is already set up. The question is whether anything stops it. In a hard landing, the next 12 to 18 months unfold roughly like this. Unemployment rises faster than expected. The Psalm rule triggers in the next month or two. Headlines confirm what the Moody's model has been saying. Recession watch becomes recession. Consumer spending, already wobbly, contracts. Discretionary categories collapse first. Restaurants, travel, home improvement, cars. The categories that depend on confidence and credit access. Corporate earnings miss in the second half of the year. The mega-cap technology names, priced for perfection, get repriced. The S&P 500 corrects 15% at first, then 20%, then 25%. The artificial intelligence narrative does not collapse, but the timeline for revenue gets pushed out. Companies cut capex. Data center construction slows. The capex-driven economic stimulus that has been propping up gross domestic product evaporates. Banks tighten credit aggressively. Their exposure to artificial intelligence-adjacent companies forces defensive action. Lines of credit get cut. New lending dries up. Healthy companies that were planning to refinance get caught with more expensive borrowing or no borrowing at all. Some healthy companies, deprived of credit, cut staff or sell assets. The credit crunch spreads beyond AI to the rest of the economy. Private credit losses surface. Funds that were marking loans at face value can no longer pretend. Markdowns cascade through pension fund portfolios. Some pension funds find themselves underfunded. The pension underfunding becomes a political crisis in some states. Pressure mounts for federal intervention. Housing, already weak, weakens further. Foreclosures, which have been quietly rising, accelerate. Banks repossess properties. Inventory builds. Prices fall in the markets that overshot during the pandemic boom. Florida, Texas, Arizona, Nevada, some homeowners go underwater. Negative equity becomes a household word again. Construction employment, already shrinking, contracts further. The Federal Reserve responds aggressively. Rate cuts come faster than markets expected. Quantitative easing, the practice of buying long-term bonds to push yields lower, returns. The Fed cannot solve the supply-side problems, but can support demand. Markets initially rally on the Fed action, then realize the rate cuts are responding to deteriorating fundamentals. The rallies fade. Fiscal authorities scramble. Stimulus checks become a political topic again. Various forms of relief get debated. The federal deficit, already enormous, expands further. Long-term Treasury yields, paradoxically, may rise rather than fall, as the bond market questions the sustainability of the fiscal trajectory. Mortgage rates stay stubbornly elevated even as the Fed cuts the front end. The unemployment rate climbs to 6%. Then 6.5%. Some sectors, particularly retail, restaurants, and discretionary services, see double-digit unemployment. The jobs that disappear in this scenario are concentrated in the bottom half of the income distribution, deepening the K-shaped divide that already existed. Consumer credit defaults rise sharply. Credit card delinquencies spike. Auto loan defaults accelerate. The collection economy expands. Bankruptcy filings rise. The household debt overhang that built up during the easy money years finally has to be processed. The processing is painful, slow, and individual. The political consequences are significant. Whatever administration is in office gets blamed. Public trust in institutions, already low, declines further. Economic anxiety drives political polarization. Cultural conflicts intensify as material conditions worsen. Eventually, the cycle bottoms. It always does. The question is when, how deep, and how much damage gets done along the way. A typical post-war recession has lasted 10 to 11 months. Some have been shorter. The 2008 cycle was 18 months. The current setup, with its supply shocks and policy constraints, could land anywhere in that range or slightly worse. This scenario is not certain. Many of the worst cases require multiple shocks to compound. Each individual element might be manageable. The combination is what makes it dangerous. And right now, the combination is in place. When recessions hit, they hit unevenly. The same economic shock affects different households in completely different ways. A family with savings, equity, and stable employment can weather almost anything. A family without those things can be destroyed by a single missed paycheck. The American household balance sheet today shows a country that has split down the middle on financial resilience. The top half of households, by net worth, has accumulated significant wealth over the last 15 years. Homeowners who bought before 2020 are sitting on enormous unrealized gains. Equity in their homes has more than doubled in many markets. Stock portfolios have grown alongside the bull market. Retirement accounts, for those who could fund them, have compounded into meaningful balances. For these households, a moderate recession is uncomfortable, but survivable. They have months or years of expenses in savings. They have equity they can borrow against if necessary. They have employment that is generally less cyclical than the bottom half. They might cut back on vacations or delay a kitchen renovation, but they will not lose their homes or their retirement plans. Their long-term financial trajectories are secure, even if they take a hit. The bottom half tells a different story. Roughly 40% of American households would have difficulty covering a $400 emergency expense without going into debt. About a quarter have no savings at all. Most lack significant retirement accounts. Many rent rather than own. Their primary financial buffer is the next paycheck. For these households, even a modest job loss can trigger a financial crisis. A laid-off worker who finds another job quickly might be okay. A worker who is unemployed for a few months will likely fall behind on rent, utilities, credit cards, or all three. The damage from extended unemployment compounds. Once a household falls behind, getting back on track takes years even after employment is restored. The middle of the distribution has been quietly hollowed out. Families that would have been comfortably middle class a generation ago are now financially stretched. They might own a home but be locked into a high mortgage payment. They might have some savings but not enough to weather a major job loss. They are the families that look fine on paper but live with constant low-grade financial anxiety. This hollowing has happened for many reasons. Wage stagnation relative to the cost of living, the rising cost of housing in productive metropolitan areas, the explosion in healthcare costs, the decline of pensions in favour of self-funded retirement accounts that most workers are not adequately funding, the consolidation of industries that has reduced bargaining power for employees. Each factor alone might have been manageable. Together, they have squeezed the middle class into financial fragility that prior generations did not experience. The K-shaped recovery from the pandemic accelerated the divergence. Asset owners benefited from rising stock and home prices. Renters and non-asset holders were left behind. The wealth gap, which was already at multi-decade highs, has widened further. In a hard landing scenario, this distribution becomes politically explosive. The bottom half will be devastated, the middle will be squeezed, the top will be inconvenienced. Public attention will focus on the visible suffering. Pressure will build for redistributive policies, debt forgiveness, or other interventions. Whether those interventions arrive, and in what form, will shape the political and economic landscape for years afterward. There is also a psychological dimension worth noting. People who have lived through previous recessions know how to navigate them, even if barely. People who have only known the long expansion since 2009, including most younger workers, have never lived through one as adults. Their behavioural responses to deteriorating conditions are unpredictable. Some will cut back hard immediately. Others will deny reality and continue spending until forced to stop. Others will panic prematurely. The aggregate of these responses will affect how the cycle unfolds in real time. What can be said for certain is that the household distribution today is more bifurcated than at any point in modern American history. The aggregate numbers hide enormous variation. Some households will breeze through whatever comes, others will be destroyed. For tens of millions of Americans, the recession is not something to worry about, it is something to survive. It started months ago, by some measures years ago, and the official statistics have not caught up. The bottom 60% of American households, by income, are in a different economy than the top 40. The top is doing well. The bottom is struggling. Aggregate gross domestic product growth, fueled by the top, masks contraction at the bottom. What does that contraction look like? On the ground. It looks like a single mother in Tucson rotating which utility bill she will pay this month, knowing she cannot pay all of them and choosing whichever has the most aggressive. Collections process. It looks like a construction worker in Detroit watching his hours get cut from 40 to 32 to 28, with no explanation, just less work to do. It looks like a teacher in rural Pennsylvania driving for ride-sharing services on weekends because the salary alone no longer covers rent and groceries. It looks like a retiree in Florida calculating whether the new air conditioning unit can wait another summer, knowing that another summer might not survive without it. It looks like a college graduate in Atlanta sleeping on her parents' couch because the entry-level jobs in her field have either disappeared or pay less than her student loans. Require. It looks like a small business owner in Ohio, 3 months behind on commercial rent, debating whether to close before the eviction. These stories do not make the financial press. They do not move the stock market. They do not register in the leading economic indicators in any way that the indicators were designed to measure. They show up only as they aggregate. As more applications for assistance programs, as longer wait lists at food banks, as rising rates of credit card and auto loan delinquency in specific zip codes, as lower spending in discount retailers, even as luxury sales hold up, as the 53.3 reading on consumer sentiment that does not match the gross domestic product growth rate. Food insecurity after declining for years has been rising again. Food banks across the country report record demand. Some have had to ration, some have had to turn families away. The face of food insecurity has changed too. It is no longer just the chronically poor, it is increasingly working families who used to be solidly middle class, households where one or both adults work full-time but cannot afford groceries. Eviction rates have climbed in many cities. The pandemic-era moratoriums are long gone. The federal rental assistance programs have ended. Tenant advocacy groups report that calls for help have surged. Many of the calls are from families who have never been evicted before and who do not know how the process works. Mental health indicators have followed the same pattern. Anxiety and depression have risen. Substance use has risen. Deaths of despair, the deaths from suicide and overdose that economists started tracking after the opioid crisis, have remained elevated. Each of these is a downstream consequence of economic stress. The bottom of the K is not a statistical category. It is millions of human beings facing daily decisions about which essentials to give up, which bills to pay late, and which debts to default on. The conversations they have at their kitchen tables are not abstract economic models. They are choices about which child to disappoint about new clothes for school, which medical appointment to skip, which utility to let lapse. The official Recession Dating Committee at the National Bureau of Economic Research uses specific criteria. Real personal income, real employment, real industrial production, real personal consumption expenditures. By those measures, the country is not yet in recession. By the measures that would matter to the bottom 60%, by their grocery bills, their utility bills, their rent, their job security, their household stress levels, the recession has already arrived. It has been arriving in slow motion for over a year. The official statistics have simply been measuring the wrong people. Whatever the broader economy does next, the bottom is already in pain. The question is whether the pain stays concentrated there or spreads. This is where the warning signs lead. To a moment of choice. Several moments, actually. Choices for households, choices for businesses, choices for policymakers. Choices that, taken together, will determine which version of the next 2 years actually unfolds. For households, the choices are practical and personal. People in the top half of the distribution will need to decide whether to maintain spending or pull back. Pulling back protects them individually, but contributes to aggregate weakness. Maintaining spending supports the economy, but exposes them to risk if the downturn deepens. There is no clean answer. Most will muddle through, making small adjustments rather than large ones, watching the data, hoping for clarity that does not arrive. People in the bottom half have fewer choices. Their spending is mostly already at the floor. The question for them is how to absorb additional pressure. Which corners to cut? Which bills to prioritise? Which sources of help to seek out? The bottom of the K is a survival situation, not a planning one. For businesses, the choices revolve around investment. Companies that pull back early may be too cautious if the downturn turns out to be mild. Companies that maintain aggressive investment may be exposed if conditions deteriorate. The decisions made in the next few quarters will determine which firms emerge stronger and which emerge weaker. Most chief executives are watching their competitors as much as the economic data, hoping to time their moves to the herd. For policymakers, the choices are the most consequential. The Federal Reserve has to decide whether to cut rates aggressively, supporting employment at the risk of allowing inflation to entrench, or hold the line, fighting inflation at the risk of deepening the labour market weakness. Each path has costs. Neither is clearly correct. Fiscal authorities face their own trade-offs. Stimulus spending could cushion the downturn, but worsen the deficit and inflation. Austerity could improve fiscal sustainability, but accelerate the slowdown. The political incentive in an election year is usually towards stimulus, but the bond market may not allow unlimited fiscal expansion without raising borrowing costs in destructive ways. Geopolitical decisions matter too. The trajectory of the Middle East conflict will determine oil prices. The trajectory of trade negotiations will determine tariff levels. Each of these is influenced by domestic political choices, but also by the choices of other countries. Coordination is possible, but rarely happens. Misunderstandings cascade in unpredictable ways. Ordinary citizens have limited influence over most of these decisions, but they have full influence over their own financial behaviour. The choices that protect a household through a downturn are not exotic. Build savings if possible. Reduce high interest debt. Avoid taking on new obligations that depend on rising income. Maintain employability through skills and networks. These are the same boring recommendations financial advisors have always given, and they remain correct. The single most useful frame for thinking about the next 2 years is probabilistic. There is a meaningful chance of a recession, perhaps 50% or higher, depending on which model you trust. There is a meaningful chance of muddling through with a sharp slowdown but no formal recession. There is a smaller but non-trivial chance of something worse than a typical recession. And there is a slim chance of a clean soft landing, the scenario the Federal Reserve has been trying to engineer. Each scenario calls for different preparation. A recession requires defence, a soft landing rewards offence. The trouble is that nobody knows which scenario will materialise until it does. The best a household, business or policymaker can do is prepare for multiple outcomes simultaneously. Hedge against the bad. Position for the good. Accept the cost of the hedge as the price of resilience. The warning signs are real. They have been building for a long time. 5 of 9 months of negative job growth. Sentiment at 50, 3.3, the leading economic index falling for 19 straight months. Moody's at 49%. the psalm rule one print away from triggering. Consumer credit stress rising in low-income areas, housing in its own quiet recession. The artificial intelligence build-out creating both stimulus and bubble risk. Oil at 112, tariffs grinding away at margins. The Federal Reserve cornered between mandates. Some configuration of these forces is going to determine what comes next. Not all of them will turn negative. Not all of them have to. Even if half do, the next year will be hard. This time may not be different. It may simply be the same story, with the same patterns playing out one more time. The signs are back. The clock is ticking. What comes next belongs to the choices made in the months ahead.